And I believe that the factors at play still provide it with a tailwind. And when those factors are no longer at play, I'll write about how the bull market in gold is done. And whether that's a 2,800, 3,000 an ounce, or 5,000, that I don't know. I just know that the supporting factors at play are still in play. Actually, my last personal trade was to buy silver coins and silver bars. So, I like both, but silver's trading at a very steep discount. You're going to be able to make, between now and the end of next year, equity-like returns in the treasury market without having to take on equity risk. So, I like the bond market a lot. That is my highest conviction call.
Hey guys, welcome back to Capital Cosm. Today I have the great pleasure of interviewing former Merrill Lynch chief economist, David Rosenberg. Thanks for coming on the show, my friend.
Well, thanks for having me on. We're going back a long way with the Merrill Lynch days, but it was a great memory.
Yeah. I mean, it's a big part of your career, and let's start with that. For people who may be coming across your work for the first time, the one or two out there, I know you're very acclaimed, but this is your maiden voyage on the show. Tell us about your origin story, David. How did you get to the place that you are today?
Well, we have to actually go back, well before the Merrill era. I think that where I really cut my teeth as a young economist was when I was the financial economist at the Bank of Nova Scotia, and I started that day on October 19th, 1987. So when people say, "Boy, you're a real perma bear," well, which I'm not. But when you start your career as a street economist on a day where the stock market goes down 23%, you're going to have this dark cloud around you for a long period of time, especially when I put all whatever little savings I had into the Scotiabank equity pension fund just the week before. But that's when I started to figure out how, as an economist, to speak to traders and salespeople and decision makers. And I realized that the key to success was going to be in a cogent and coherent way to take the economic data points and then formulate an investment strategy out of it. And then from there, I went to the Bank of Montreal, and it was, I think, in 1998. You see, I used to do the morning meetings there, for the Treasury group. And the person who was head of Treasury that went on to become CEO, Bill Down, came to me at some point and asked if I could put my morning meeting down on paper. And primarily because I just talked too fast, so it was always broken telephone. So this was actually in the early days of the internet, and so I was posting my thoughts online, and it went viral. And from there, that's what got me the job at Merrill Lynch Canada, then Merrill Lynch US in 2002. So that's how I cut my teeth. And I really don't know, in this game of snakes and ladders, and you look at your career, I've always just made it a point of just doing what I just said, take the economics and make it relevant for investors. So nothing you'll ever see from me or my team will ever just stop at GDP or ISM index or consumption. It'll always be attached to a market call. And then secondarily, I guess that I would say, and this is my ethos, for better or for worse, is that, and I've always instructed my team since I was managing teams going back well over 2 decades, that it's so easy in the world of economics to sound like your competitors, sound and look. It's really a commodity. So the key to success is to not be a commodity. Make your vision, your opinions, your forecasts Make them unique and differentiated. Don't be scared to take risks, and don't be scared to make mistakes. Just know when to admit them and know when to cut your losses when you're on the wrong side of the trade or the wrong side of a market call or an economics call. That just takes discipline and knowing the shade of gray between having a backbone and not waffling, but at the same time not being stubborn. So the real critical, measure for success is actually, in my career, hasn't been whether you get calls right or wrong. It's when portfolio managers and CIOs have said to me after a meeting, "You gave me something to think about," or "I haven't heard that from anybody else." That's really how you add value because getting the calls right sometimes is just pure luck or just timing. But value added in terms of being effective in the decision-making wheel of a portfolio manager or a CIO or anybody who's managing money for a living, the importance for the economist is to be that cog and to provide information and intelligence they're not going to get anywhere else.
Yeah, all very true. I mean, often, I mean, you don't need to be the N plus one person to be shouting on the rooftops the exact same thing that, N number of people came before you, right? There's got to be a unique, at very minimum, a unique spin, a unique twist to what you're adding to the conversation, to what you're adding to insights and so forth. And it does seem, and like you mentioned, you don't just look at GDP or XYZ metric. When I also look at this stuff, it's more of a confluence of evidence. All these things, some may be pointing to contradictory insights or contradictory conclusions, but it's only when you take the tapestry of these metrics that you can kind of really start to paint a picture. Do you see that as well, or do you have a different take on that?
No, I think let's call it dare to be different. And it's a matter of coming up with an intelligent and informed and understandable way of looking at the world, and especially the world of economics, which is very complex, and then simplifying it for people that aren't in the economics field, but need the interpretation of those data points to make decisions. And that's really what's critical in terms of what I do. And case in point is I've been spending a lot of time just in the past 6 months talking about how you don't need to actually have an NBER defined recession in your forecast to be bullish on interest rates. And here we've had a situation where real GDP, which is the proxy for aggregate demand, has been running at 3% year over year. And yet you've had all these other things happening. Underlying inflation has come down, the unemployment rate has gone up, industry-wide operating rates have come down, all in the context of 3% growth. And the question becomes, how do you explain all that? Because normally in our lives, 3% GDP growth, we'd be seeing huge inflation, the unemployment rate would be going down, not up. And so as I see the collage of these data points, I can understand what's been happening. Then it's a matter of can we try and prove it? So I've been spending a lot of time, maybe call me, Arthur Laffer, or call me a classic, supply side economist, but focusing a lot on what's happening on the supply side, excuse me, of the economy, because that's been a story that's not been being published a lot, but is at the heart of what's happening with the Fed and with interest rates right now, is more what's happening on the supply side than on the demand side.
Interesting. Yeah, you often hear two different narratives when it comes to the inflation that we've dealt with over the course of the last 3 years. There's the demand side narrative, and there's also the supply side narrative. Do you see is the inflation that we're dealing with now, although reportedly it's down to 3% annual? We'll get into whether you agree with that number or not. But do you see it? Do you put more weight on the supply side story, i.e., the supply chain breaking over the course of 2020 to 2022, causing this cost push inflation, or is it do we put more of the blame on the monetary policy of pumping all of this money into the money supply in during those years? How do you see it, David?
Well, look, we had a situation where COVID created all sorts of distortions, and not just domestically, but globally. So even after the worst part of COVID in the US, we had China, God forbid, a handful of COVID cases, and they were shutting down port cities of 20 million people and then further clogging up the global supply chain. So we had all this supply side developments going on. We also had a massive fiscal and monetary policy response. And that's what brings us to, well, for 1 month, 9% inflation. It didn't stay there. And I guess we could all debate whether 18 months in the overall annals of economic history is transitory or not transitory. But I would say that even to the most ardent inflationists, getting a 9% even for 1 month, that was a big shock.
Mhm.
So you're right. You had monetary and fiscal policy together. It's easy to look at this in the rearview mirror because there was a point in 2020, 2021 where we thought this was the bubonic plague. And there was a massive overreaction with the benefit of hindsight. And then we had, of course, the global supply chain picture creating a lot of the cost push inflation on the production side, as you alluded to. And then on top of that, the government paid people not to work. You had enhanced and extended jobless insurance. And in a lot of cases, especially in the low skilled cyclical service industry, leisure, hospitality, retail, people were getting paid more to be in the dole than they were to go back to work. So companies had to pony up a lot more on the wage side to attract people back in the labor market. So all that is in the rearview mirror, but that's the situation that we had in 2021, 2022, and in 2023. But it's interesting that, you don't hear, I mean, all the production bottleneck measures are running negative. They're back to where they were before COVID. Uh, but the real key, and of course, this is what Jay Powell's been focused on, is what's happening in the labor market. Now, if you go back to that new metric that Powell basically constructed or told us to look at, which was the cyclical services, X energy, X rents in the CPI number, was not because this was some newfangled, item that the Fed was targeting. It was basically really just about focusing on that particular item because it was reflecting the supply demand imbalance in the labor market, in that part of the labor market, mostly retail and in leisure hospitality, that was most concerning to the Fed at that time. Well, and it was around that time that you also heard people talking about, the participation rate will never come back. The great retirement theme. Do you remember that? The great retirement theme. You don't hear about that anymore. You don't hear about production bottlenecks. I mean, maybe every now and again when the Houthis in the Red Sea, start to get active. But you don't hear a lot about that aspect of it. What you're hearing mostly about is how China is exporting its excess manufacturing capacity around the world. There was an article about that over the weekend in the Wall Street Journal. We've been writing about that at Rosenberg Research for the better part of the past year. In the product side, you've reversed course from China being a source of inflation because of the broken supply chains emanating from there. Now they're basically exporting their excess manufacturing capacity, and that's having an impact on the product sector. And the product sector is 40% of the CPI, although we focus primarily on services. But even on the services side, inflation is coming down and coming down precipitously. I don't hear a lot of people talking about sticky inflation anymore. And in fact, about a year ago, I said sticky inflation will go the way of the great retirement narrative, which is that it's going to be retired. So you've got a couple of things going on that are very beneficial for the inflation story. We can debate whether you agree or I agree with the machinations that go alongside creating the consumer price index or the PC deflator. But there's no doubt that the pressures on inflation are going down and will continue to go down, and principally from the labor market, because that's where three-quarters of the inflation comes from, is from the labor market. And so what's happened is that the participation rate for prime working age adults has miraculously gone up to its highest level in more than 2 decades. More people are out there competing for jobs. And that's putting downward pressure on the nominal wage rate. There's more people coming in for whatever reason. I imagine because now they have to, coming in looking for work and creating competition in the labor market. And that is incredibly disinflationary. It's why the unemployment rate has gone up from 3.4% on the cycle low to 4.3%. I don't think anybody would tell you that a rising unemployment rate is inflationary. It is disinflationary through the prism of what happens in terms of the wage cycle. But there's something else going on that's very interesting, which is productivity. You've got productivity right now running close to a 3% annual rate. And this is before all the benefits from generative AI. And a lot of it is coming from the impact of what COVID did, because the lockdowns, the pandemic, forced companies, especially in the service sector, in retail, and in hospitality, that if you did not have a digital footprint, you're going out of business. You had to basically adopt an Amazon type of business model, or you are going to become defunct. And those are the areas, these sclerotic areas you don't think about. Low value add, cyclical services, parts of the economy that historically aren't that productive. That's where a lot of this productivity growth is coming from. It's actually very interesting, but productivity is totally antithetical to an inflation view, because alongside what the rising unemployment rate has done to nominal wages, unit labor costs, which is productivity adjusted labor compensation, is running close to zero. And I got all these people talking about inflation, inflation, inflation. Unit labor costs, which is the mother's milk for inflation, is running close to zero right now. And that's because of rising unemployment, which is not going to stop, at least not yet, and the acceleration we've had in productivity. So that's when I talk about looking at the supply side, because if all you did in the past year was look at the demand side, you would have missed out on the disinflation, and you would have missed out on a very impressive bond rally from the Treasury yield peaks last October to where we are today, because we no longer have a sclerotic supply curve bumping against robust demand. Demand is still robust, although the 3% demand growth, which is GDP, is now shifting more towards 2%. But the aggregate supply curve is running almost double that. And that's why you've had this situation where inflation has come down materially. And it's not just because of manipulations by government statisticians. It's real. And when I look at our forward-looking indicators, that's going to be the ongoing story from now to the end of next year. People say, I hear all the time, that the last leg of getting inflation down is going to be so difficult. I don't think that's true in theory or practice. And I think people will be surprised this time next year how low the inflation rate is going to be. We've gone from 9 to call it 3 in a very short period with pretty strong demand growth. Well, what happens when the demand growth slows, which we're seeing in real time? And inflation is going to melt before our eyes. And that's why I remain steadfastly bullish on the Treasury market.
I see. So oftentimes in the market, we're forward looking. The market is forward looking because it's backward looking. It's making calls on the future based on the past. And when you look towards the past, say the 1940s, say the 1970s, you had three major inflation humps, three major inflation waves during both of those inflation eras. But what you're saying, it appears that we've kind of diverged away from those use cases. Is Is that what is it an accurate assessment, or are we still due for a secondary wave of inflation? Perhaps sometime down the line after we get through this disinflationary cycle that we're currently in the midst of.
Well, we'll have to see what happens. I mean, I'm not saying inflation is dead. I'm just saying that for now it's dormant. I'll
Mhm.
take it a year at a time. Uh, we don't know the outcome of the election just yet. We'll have to wait till November the 5th. And then, of course, whether it's going to be one party rule or split government. And the outlook for fiscal policy, the outlook for trade wars, tariffs. There's all sorts, or what they call deglobalization. I mean, these are things I have to pay attention to. No doubt, those are risks to my forecast. But my forecast right now is predicated more on productivity and where that's going, and the slack that's being developed in the labor market. I think it'd be a big mistake to take your eye off those two balls right now and probably for next year. And I'm more than willing to engage in a debate of the unknown as to what inflation is going to look like 3, 5, or 10 years from now. But I think that we would have to go through a series of recurring shocks. Now, of course, nobody in the 1960s could see what was going to happen in the 1970s. But who thought in the 1970s that we were going to be facing an OPEC oil shock every 2 years,
Mm.
and that oil was going to go from $3 a barrel, up to $40 a barrel in a 10-year span. And we were having oil shocks every year. So if you're going to say to me, well, my crystal ball says we're going to have recurring, that Trump isn't, if he gets elected, is going to raise tariffs not just once, but he's going to raise tariffs every year. If you're going to build up a straw man, and we're in a business where your assumptions drive your conclusions. If you're going to tell me tariffs are going to go up every year, because otherwise tariffs are just a price level shift in a point in time. It's not a sustained source of inflation. People go back to the 1970s, and that's all they talk about. But the 1970s, you had recurring shocks from oil, and oil back then mattered a lot more to the economy than it does today. The degree of unionization today is a lot lower than it was back then. And the first of the boomers, that 80 million picking up Python, were just starting their households. And so spending on appliances and furniture and housing and automobiles was through the roof. So in those periods where you didn't have a Volcker-induced recession, well, I guess that came earlier because he started in 79. But we had three recessions from 1970 to 1980. And they were induced by a reversal in monetary policy. But you see, when we weren't in recession, and we were not in recession all of the 1970s, the economy was expanding 80% of the time. And believe me, when it was expanding at over a 5% annual rate. Why? Because you
Mm.
had vibrant demographics. Well, we don't have the same today in that respect. And we have a much larger debt constraint in the government sector. So, are we going to get fiscal stimulus on top of the fiscal stimulus? Well, we'll see. A lot of that is ultimately going to have to be paid for somehow. But I think that conditions are far different. The demographics, the nature of the inflation in the 1970s, the fact that, what happened to all that talk? Starbucks gets unionized here, and you've got other unions starting there. And I mean, I was hearing this 3 years ago. You tell me what happened to that narrative, the rise of labor power, and unionization. Meanwhile, despite all the headlines and all the fear mongering that went on, the share of the workforce that's unionized is the lowest it's ever been today. So no, I don't buy into that. There are risks to the disinflation. I think what happened was we got hit by a shock. We had a very aggressive policy response to the shock. And the one thing that central bankers are aware of is that they know better now than in the 70s how to fight inflation. And remember that Jay Powell, the whole way through in that tightening cycle, from 2002 to 2022 to 2023, who did Powell compare himself to? You want to talk about the 1970s? Well, I asked the question, did he compare himself to Arthur Burns? No. Did he compare himself to McChesney Martin? No. Did he compare himself to anybody else other than Paul Volcker? That's all he did. And actually, it was the most Volcker-esque tightening in monetary policy since the Volcker years of the early 80s. So these central bankers know how to kill inflation. It's probably just a miracle that we haven't had the recession yet, although I still think it's going to come. But so far, we've had the soft landing. But central bankers understand inflation a lot more now than they did in the 1970s.
I
So I
see.
think there's some critical differences. And I'll tell you something else. There is no, I hear this all the time, we'll inflate our way out of our debts. No, that's not going to happen. We already had inflation. The debts only went up. And now the debts have become more intractable because we're spending $1 trillion a year now on interest expense on the debt. So there is no get out of jail free card. And what the politicians know and what the central banks know, which maybe they didn't really appreciate in the 1970s, is that inflation is a tax on the most vulnerable parts of society, the low end consumer and the elderly. So I don't see that we have an election campaign right now in the United States premised on modern monetary theory. No one talks about that anymore. Nobody talks about we have to actually have a policy of inflation or reflation. In fact, the whole thing is about how to fight inflation on a long-term basis. That's all the Trump team and the Harris team are talking about. So there is no public appetite. There's no political appetite for inflation because they realize that it ruins societies. And history shows that it actually brings down governments. So I think all the inflationistas out there, I don't have that view. Admittedly, for 18 months, I was dead wrong. It was interesting that Powell talked about at Jackson Hole about all the shipmates he had on the transitory narrative, and the reality is that I was there too, but it was temporary. If you're willing to admit that 18 months is not actually a whole decade like the 1970s.
Right. We do have a huge backdrop today that we didn't have back then, however, which is we've got multiple powder kegs ready to blow, geopolitically speaking, in terms of potential kinetic wars in Europe, Middle East, potentially even the South China Sea. Um, aren't isn't historically war an inflationary phenomenon? Like, or isn't there a huge risk that if one of these or all of these pops off, then we could see a resumption of cost push inflation through that mechanism?
Well, it's 100% true that wars are inflationary. The question is, how long will they last? So if you have, World War One, World War Two, I mean, these are multi-year global wars. Um, yes, that would be inflationary. And the key is because right now all we have is we don't have a global war. We have regional hostilities, obviously in the Middle East. We've had this war going on for several years now between Russia and the Ukraine. It created an instantaneous inflation shock, but it's not been inflationary since. It was like it was like a level shift, especially in
Mhm.
energy prices and food prices, and had a bigger effect, obviously, in Europe than it had in the U.S. I'd say yes, a global war would naturally be inflationary. If we have a situation that involves Iran, where we start getting, um, you know, production stoppages when it comes to oil, that would be rather significant, especially if it is sustained. And that's why and Powell brought this up about that's what's so critical about inflation expectations. And that's the one thing that central banks always want to be aware of, because once something that's temporary becomes permanent and it gets reset in inflation expectations, it's very hard to reverse course. That was first and foremost on Powell's mind, was the risk that inflation expectations were going to become unanchored. in wage settlements, in inventories, in business decision making. And that's really created all the distortions we had in the 1970s, where it was viewed that something that was transitory, which was an OPEC shock in 1973, was going to stay temporary, but that's all we saw throughout the entire decade. So we saw right there that something that's temporary becomes permanent, gets embedded in inflation expectations, and that's when you get the upward spiral between wages and prices until the Fed has to go nutty on rate hikes and really kill demand, and that's what takes over, and that's the story. So again, it's a case, where your assumptions drive your conclusions. If you have, and I don't know, how do you handicap what's going to happen with all these skirmishes, China and Russia and what's happening in the Middle East. It's a complicated development in trying to forecast what it's going to mean for inflation. But if it does cause commodity prices, I mean, here we've had all these hostilities, all these skirmishes, and yet the Bloomberg Commodity Price Index is down 30% from the cycle peak, even with all that. So if the global military conflict spread, if somehow the U.S. gets dragged into it, it's going to have a simultaneous impact on supply chains, oil prices, but also probably have an impact on demand. But would it be an inflationary shock? The answer is yes. And then the next question is going to be, will it be sustained? And that's the more important question. And that we just don't know yet. But as you said, it should be on our radar screen, and it is.
Yeah, 100%. You did bring up the elections. According to the betting markets, you're looking at most likely a split Congress, Democratic House versus a Republican Senate. On the presidential side, it's more evenly split. It's, pretty much a 50-50 split. Now, assuming we get a split Congress, how does the market react to a Kamala presidency versus a Trump presidency? How do you see the two different scenarios play out?
Well, if it's a split government, I think that the markets will breathe a sigh of relief in both cases.
Mm.
And I think in the case of Harris, I'd probably find that she will not get a lot of her fiscal policies through, or maybe none of them. So I think we'll just be in this state of fiscal gridlock. But the problem, I think, in some sense for Trump, is that there is appetite for tariffs. And even the Democrats, their appetite for tariffs is just that, only Donald Trump is campaigning on the broad-based and sharp run-up in tariffs that he's talking about, which again would be inflationary for a time. That would be a pretty significant price shock. My sense is that the most important thing, and you brought it up, is that if it's a split government, then we probably go through more gridlock. I'd say that even though Trump would be arguably more successful in getting the tariff hikes through than Kamala Harris would be in terms of getting a lot of her fiscal goodies through to the low and middle income households. And then the next question would be whether Donald Trump could get his corporate tax rate reduction done, and probably not. I think that the Trump presidency would probably end up being still disinflationary in the sense that his tariff policy would lead to a one-time price increase, unless he's going to raise tariffs every single year, which I'm not hearing he's doing. But he's going to do a lot more to deregulate. And the deregulation is going to have a more permeating impact on the inflation landscape. So I think that would actually be beneficial. Probably you could argue for treasuries and for equities. As far as Harris is concerned, I would say that probably something very similar. I think that fiscal policy isn't going anywhere, and we're just going to end up having gridlock. I think that you could argue in both cases that the markets would just breathe a sigh of relief that the vote was really, if it's a split government, as far as the Democrats are concerned, that America is at least not going that far left of center. Um, so I'd say that in both cases, probably positive both for bonds and for stocks. I would say that in actuality, fiscal policy with a split government with the Democrats might be tighter than it will be under a Trump presidency. So it might be tilted more in favor of the bond market if she wins than the stock market. But in both cases, you can build a positive case for both asset classes, so long as the legislative branches remain divided, and that's the real key. I mean, that is the real key because you find historically, it's more often than not, the first 2 years of a winning candidate for the White House, they usually take the House and the Senate. And you saw that, for example, with George W. Bush, and you saw that again with President Obama. The Obamacare happens in the first 2 years,
Hmm.
and then you just have tight fiscal policy the last 6 years because of the split government. You had the same thing with Donald Trump the first 2 years. Um, it's one party rule. He does not get his tax cut through. And it happens in the first 2 years. And then there's nothing in his last 2 years, really, except more deregulation, which he can do through executive order. And Joe Biden and $2 trillion stimulus check just by the snap of his finger because let's face it, there Donald Trump blew the Senate for the Republicans. They had to wait till the midterms before we had the split government. One party rules. Next thing you know, Joe Biden gets his $2 trillion giveaway, which was the Energizer Bunny that kept on giving right up until recently, and a huge boost to the economy. And that was a primary source of inflation, too, for the time that it was there. That doesn't happen. So I think the critical part of your question is 100% that what matters is down ballot.
Mm.
As far as how you would formulate how you want to position in your asset mix, it will come down to whether or not it's one party rule for the next 2 years, because you can either do a lot of good or a lot of damage in those 2 years. So if the president is hamstrung by the down ballot, then I actually think, tell you the truth, that'll be a good thing because that'll be the check and balance. And I think the markets will actually prefer that to one party rule in either direction.
Gotcha. Well, let's pivot over to what's been somewhat of a rock star over the better part of this year, and that is gold. Gold has been making new all-time highs pretty much regularly now. It's sitting at 2550 and some change at the time of this recording. I just want to get your general take on the precious metal sector, David. What do you make of this rising gold price? What is it signaling per se, and how do you see it in general?
Well, I think what's very interesting is that normally people would say, well, gold's a hedge against inflation, and inflation has come down, and gold's gone up to record highs. And the CRB index and a lot of these industrial commodities have come way down, and gold hasn't followed suit. And that's because the complexion of gold has really undergone a fundamental reorientation, where it is no longer viewed really as a commodity. It's viewed as a currency, and a currency that has no government's liability. So I think that investors are looking at this massive run up in global debts uh, and fiscal instability. I think to some extent, you've also had central banks, especially the BRICS, increasingly diversify outside of the dollar towards bullion. And a lot of that came out of the White House decision to freeze the Russian dollar reserve assets. So you have a lot of other, so call them rogue states if you want, that are thinking, well, we got to diversify our dollar reserves. What was really impressive with gold is that in the past 12 months, it managed to hit or approach all-time highs against every currency in the world, not just the US dollar. And that's telling you that investors are looking at gold more as a currency than a commodity, and importantly, a currency whose supply curve is very stable and does not represent any government's liability as currencies or what you call fiat currencies do. So I think there's the stable characteristics of gold. And on top of that, what are the principal drivers of gold? Well, two things. Interest rates, since the opportunity cost of holding gold is the coupon, and interest rates are coming down. So check, that's bullish. And since it's priced in US dollars, well, the US dollar has entered into a major corrective phase, which is going to continue because the Fed was nobody went as far as the Fed did on the rate hiking cycle, and other central banks, many of them have already cut interest rates, not just once but several times, and so the Fed has a long way to go to play catch down to these other central banks. So weaker dollar, lower rates, all these other structural factors that I'm talking about has led to this bull market in gold. Now, people say to me, where do you think gold is going? And I've been saying for actually years, we're going to go to $3,000. We're approaching that level pretty fast. And then I don't know what to do once we get there. And I say once, I'm not saying if. And it's not a matter of hitting a price objective and then cutting bait. It's really going to come down to, are the factors that are underpinning the bull market in gold, are they subsiding or are they still in place? And if they're still in place, you'll have to still be bullish on gold. It's very difficult to establish a price for gold, a price objective. It's not like the stock market, the S&P 500. Is it really that difficult to have a price objective for the S&P 500? You need earnings and you need the multiple. Or is it difficult to have a forecast on the 10-year Treasury note yield? What's the real rate? What are inflation expectations? What's the term premium? Or you want to do interest rates or spreads in the corporate sector? Well, what is inflation going to do, and what are default rates going to do, and recovery rates? The stock market, like I said before, earnings, multiple, price to book, price to sales, price to EBITDA, do a dividend discount model. But gold doesn't provide you a cash flow stream. So it really comes down to less of a price objective and more is the direction. Does it still have a tailwind or not? And I believe that the factors at play still provide it with a tailwind. And when those factors are no longer at play, I'll write about how the bull market in gold is done. Now, whether that's a 2,800, 3,000 an ounce, 4 or 5,000, that I don't know. I just know that the supporting factors at play are still in play.
What about silver? Silver hasn't been making new all-time highs. As a matter of fact, it's 40% off its all-time highs. What's the deal with silver? Why is it lagging behind, in your opinion?
I think that's because I think that global growth projections are coming down, and silver has more industrial properties than gold does. So you'll tend to find that silver will lag gold when global growth expectations are receding. However, the discount to gold is very wide. And actually, my last personal trade was to buy silver coins and silver bars. So, I like both, but silver's trading at a very steep discount. But it's lagged behind because it has more cyclical properties at a time when global growth is cooling off.
Gotcha. Well, hey, is there anything else you'd like to talk about? I think we've covered a pretty wide gambit of things, but I want to leave the floor open to you, David. Is there anything else we didn't get to that you were looking to speak about?
Well, I'll just finish off by maybe my highest conviction call is maybe not even with gold, although my primary thesis is the bond bullion barbell because I love alliterations. But I would say most importantly and very recently, we've had Jay Powell invoke 2019. He did it in the Q&A on July 31st at the podium at the post-meeting press conference. And then in his text at Jackson Hole, he invoked 2019 not once but twice. And when I say invoke 2019, he deliberately said that the labor market, he mentioned the labor market 11 times. So the bottom line is that we can talk about sticky inflation and inflation. The Fed has moved on to the labor market, where the slack is expanding rather significantly. And there's something in the labor market. Remember, the Fed has more information than we do. Not that they don't make mistakes, but Jay Powell has a lot of information. And something's happening in the labor market that bothers him in a different way than it did 2 years ago when it was super tight. Now he's concerned that it's getting too loose. And he came out and said that. But when he says that, the labor market has more slack now than it did in 2019. And in fact, after the last FOMC meeting, he said things have normalized to where they were in 2019. Well, what I would want to stress to the viewers is that everything has normalized to 2019, except for the funds rate. And the funds rate right now is 5 3/8. And he invokes 2019 when the funds rate was 1 3/4 at the end of that year before COVID. So I think the biggest mismatch, and that's what I try and do, I try and identify what the market is not seeing. And everybody's asking me the same question because the swaps market has 100 basis points of Fed rate cuts between now and the end of this year. And that might be too aggressive. However, the same market believes the Fed will take the funds rate this cycle to 3.25%, and that will be the terminal rate. And that's where I see the anomaly. That's where I see the anomaly because I think that they're going back to 2019. I'm not saying we're going back to the zero bound, but if things have normalized to 2019, ipso facto, the policy rate's going to where it was in 2019. So as Powell said, the pace and the path will be determined by how the balance of risks evolve and the labor market. So I don't know, 25 or 50 at September 18th, who knows? That's a flip of a coin. But where I have strongest conviction is the destination. And the market's priced for 3.25, but I have a strong suspicion they're going to 1 3/4.
Interesting.
And that's going to be huge for the call on treasuries.
That's a big
because it tells
spread.
me when you do the yield curve dynamics, where will we be at the low on the funds rate on the 10-year note? 2 3/4. Where will we be in the long bond? 3.5. And that includes the work we've done establishing a fiscal premium. You're going to be able to make between now and the end of next year equity-like returns in the treasury market without having to take on equity risk. So I like the bond market a lot. That is my highest conviction call. The yield curve will pivot to its more normal shape. The whole curve will come down. The biggest yield decline will be at the front end of the curve, but the greatest return potential will be at the long end of the curve. And that is my highest conviction call for the coming year.
Well, David, I've got to thank you so much for your time, a wealth of knowledge. Where can people find you and find more about you, David?
Sure. Well, I don't have all the information at hand because I'm a bit of a technophobe. But I have a YouTube channel and I got a Twitter handle, and I'm on Substack. But if you want to reach me and my firm, just Google Rosenberg Research, or and surf our website, and you can also contact us through information@rosenbergresearch.com, and one of my client service people will get back to you. And in fact, everybody on this call will be eligible for a free 1 month trial of everything that I do. And I encourage everybody to come to the smorgasbord and taste the wares, and hopefully it speaks to you. That's how we get most of our clients. They come on the trial and then they sign on. So that's what you can do. Either to go to rosenbergresearch.com, just Google it, takes you right to the website, or information@rosenbergresearch.com will get you right through to one of my client service people.
Yeah. And in addition, we'll have all those links posted down below, including all of David's socials there. David, thank you again for coming on. And I'd like to remind you guys, for all of your gold and silver buying needs, be sure to check out my partners at info@milesfranklin.com. Email them, info@milesfranklin.com, and tell them Capital Cosm sent you in the subject line to get special pricing that you won't find on their website. Gold and silver is Gold has been a rock star asset, as has silver to an extent, but as David kind of alluded to, it is at a bit of a discount. So email info@milesfranklin.com. Tell them Capital Cosmos sends you. Get special pricing. Also, like the video, comment down below. Go, David, go. If you agreed with David, if you disagreed, let me know why. Tell me why you disagreed. Any points you disagree with, let me know in the comments down below. Really interested to get your take there, guys. And with that said, hit the subscribe button if you're getting value out of this channel, and I will catch you in the next episode. Bye, guys.